Hey guys, how you doing? So, a few days ago I recorded a video coming back home from brunch in my SUV where I go into the basics of investing and finance, some basic rules and principles. I think if you are interested in personal finance, building wealth, getting out of the financial rat race, this is a good intro video to watch. So, just had breakfast and now we're heading back. So I'm going to discuss briefly some rules of investment. This was put to me. This was a question that was put to me recently. So I figured we'll do a car vlog. I'm going to give you a bunch of principles that I learned the hard way about investing in finance. I made a lot of mistakes not listening to tried and true principles and techniques, if you will. And I'm going to give you an outline here so that if you follow me, you won't make the same mistakes and you'll be way, way ahead. So, number one, diversification. That's an old principle. Diversification, diversified. That means scattered about, meaning spread around. One of the oldest rules in life is, there's an old parable in the West anyway, and they say don't keep your eggs in one basket. Don't keep all your eggs in one basket. You know, your chicken eggs. You're walking around with the one basket with all your eggs. You follow, all the eggs break into one basket. So that's an old lesson that goes back, I don't know how many, could be thousands of years, who knows. Anyway, you want to be highly diversified in your investments. If anybody ever tells you, no, you got to be concentrated in your investments, they're idiots. You want to be highly diversified. Why? Because none of us can predict the future consistently or with any accuracy. You never know what's going to happen. So being highly diversified prevents horrendous failure and losses. That's how people lose, right? If you are highly concentrated in your investments, it becomes gambling. And if something goes wrong, inevitably, if you're highly focused on one thing or another, one type of investor or another, eventually something does go wrong, and then you get screwed really bad. So highly diversified maximizes the opportunity for you to make money and to be fine. You probably won't get there as quickly as if you versus getting lucky if you were super invested in one particular thing. But that's just luck, right? You wouldn't want to gamble your future on a lottery ticket, right? Well, it's silly, right? Because most people who play the lottery lose. Now, I'm exaggerating the point to make a point, but at the end of the day, you want to be highly diversified to minimize your losses, to maximize your gains. And it's about being in the market. So high diversification is very important because you can't predict the future. You don't know what's going to happen. And the worst thing to do is to be highly concentrated in something, even if you're 100% sure that it's going to be fantastic. Even if you know for sure, I knew this guy was going to do it, I could tell. Even if you're 100% sure that the investment is going to be amazing, you don't know. I've seen it time and time again. So you want to be highly diversified. Here's another reason why you don't want to concentrate your investment in one thing or just two things. Because you're going to be very nervous. It's going to make you extremely nervous because you're going to invest in one thing. If that investment starts fluctuating, which it will, all investments do, you're going to start freaking out whether it goes up or down. It's going to start taking up too much psychological, too much emotional energy, too much mental energy. That's the worst thing that can happen to you. What you need to do is when you are diversified, it will remove that psychological, emotional component because you're diversified. So if one stock goes up 5%, it's no big deal. It's only one of many of your investments. So it's such a tiny part of your total investment portfolio. A portfolio is just like all your investments combined in one box. Think portfolio, think a box of investments. So if you have one of your 100 investments is one of them goes down 5%, 10%, it's nothing because it's such a small part of your portfolio. So I wouldn't be too concerned about that. So that's one of the reasons you want to be diversified. That brings me to my next point is the emotional impact of investing. You don't want to get emotional. So you need to put into place, number one, strategies that remove the emotion from the investment process. You don't want to be subject to the emotional whipsaws that investing can cause. That's huge. That's why you have to be highly diversified, because that's another reason to be highly diversified. When you're highly diversified, you remove that emotional component from the whole thing. The old Olympic Village. The old Olympic Village. So I used to live here in the 1980s. So it's like 30 odd years ago. This place right here. This was high end. This was the Olympic Village. This is where the Olympic athletes lived in the 1977 Olympics in Canada, Montreal, Canada. The stadium's right across over here. The emotional component in investing is something that's not talked about enough. It's not discussed enough in investing. It is a huge factor. It is a huge fucking factor. You have to think about that. You have to think about that. Why? Because emotions dominate us. Even the most highly trained stoic individuals are subject to emotional influence, and majorly so. The uninitiated, the un-lizard brain aware people out there, they think that they control their emotions. That is 100% wrong. The vast majority of us, the vast majority of time, 99% of us, 99% of the time, are actually totally dominated by our emotions. All the tests have been done. If you want to learn about that, check out Lizard Wizard, my course on the brain. And so you have to assume that emotions are dominating you. So what you need to do is you got to use your logical brain to put in place certain strategies that will mitigate for the emotional dominance of one's decision making. You have to get that out of the equation. So how do you do that? Well, one way is you have to be highly, highly diversified, so that when a particular investment in your diversified box, when a particular investment goes down or goes up, you don't freak out. You're not getting super excited. You're not getting super panicked. It doesn't matter. It doesn't matter. So what's this? This looks like a Porsche. Yeah, it's a Porsche Carrera. GTI is an expensive car here. This is probably the best. The Porsche 911s here. These 911s are probably the best made high-end sports cars out there. If I was going to get a high-end sports car, this would be it. But right now I drive this thing, the Genesis, which is probably a better car in my opinion. Not as fancy, although this is probably, well, I'm driving a probably much more comfortable ride. I can almost guarantee it. But anyway, another story. So yeah, lesson number 2, you have to pull emotions out of your investing. You cannot let emotions, if you're getting emotionally invested, excited or sad or anxious about a particular investment, that's a huge red flag. You have to avoid that at all costs. You want no emotions in your investment. So strategy number 1 to remove emotions, be highly diversified. Strategy number 2 is to have a long-term time horizon. So before you put money into any investment, you have to be disciplined and have it in your mind that under no circumstances will you get out of that investment, will you sell that investment within the next 7 years minimum. No circumstances. 0 circumstances. Why? Well, a couple of reasons why. Number one, psychology. Once you have that 7-year discipline, it basically pulls the psychology out of it, because that's it. You're done. Decision's over. It's happened, done. No more emotion involved because there's no decision to be made. A lot of decisions in one's life, a lot of the emotions are involved with indecision, not knowing where to go, left or right. I'm sure you've experienced it, where once you've made that decision, the time that decision occupies in your brain, this disappears because the decision is made, it's done. So when you buy a particular investment, number one, it has to be for 7 years, minimum. Number two, the reason you do that is that so that you can pull the emotion out of it. That's tactic number two. But there's another reason why you want to have a minimum 7-year time horizon for a particular investment. It makes you think not once, not twice, but 3 times. 3 times a lady. It makes you think quite a bit about whether or not you're going to actually make that investment. So you have to have that 7-year time horizon. So I'll tell you a little story time. I have to tell you, I look back at my early days of trading, when I started trading 6 figures in the early 2000s, mid 2000s, late 2000s. And I would go in and out of market, buy and sell, try to catch the tops, try to sell the bottoms, blah, 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 which is all, you may get it once in a while, but overall I did all my calculations. And I found that if I had just bought and held, even all my losers, even ones went to zero, some of them, I'd be way ahead than I ended up being after trying to time markets and try to pick the best time to buy and the best time to sell. I'd be way ahead. So, practically speaking, you're much better off to just, okay, I got money to invest. You buy an index fund, you buy some broad, diversified investment. We'll get into that later on. And then you just forget about it. It's done. It's 7 years. You have nothing to think about anymore. It pulls it out of the emotional equation, which allows you to see it run its course, to see it happen. See, if you don't have that 7-year horizon, another downside is that you may panic and sell too soon because things go down, things go up and down. Go watch, if you don't believe me, go watch any stock, any market. You see there's ups and downs, and people panic and sell when it's down. And then, because the emotions take control, and then 2 years later, it's up way beyond where they sold, and they lost. All the studies been done. People who buy and hold for years and years and years without thinking about the ups and downs, the daily or even yearly ups and downs, they end up way ahead. So you got to buy and hold for the long term. It's a discipline. It's a discipline. All right, so we got that covered. So we got. Diversification, why? We got the emotional impact on investing, how to mitigate against it. Okay, so what is an index fund? You got a book index, you buy a book, and at the front of the book you got an index, which is basically a summary of everything in the book. So an index fund is basically it's a bunch of investments summarized into one. So instead of buying, let's say, one stock like Apple, you buy the NASDAQ. NASDAQ is a stock market. You buy a certain index like the NASDAQ. So you're buying a piece of maybe 500 companies. So what's good about this? It's highly diversified. If you're trying to pick which company is going to do well, unless you're an expert in that industry, chances of you picking the winner, highly unlikely. Highly unlikely. And then again, because you only have one investment in one company, you have to count on the management of that one company. You have to count on that they're competent. You have to count on that particular industry is going to be doing well, that kind of thing. So when you buy an index fund, you're basically buying a piece of many, many, many companies. So you're protected against bad managers. You're protected against a certain industry collapsing, like typewriters or something, Let's say you had bought, stock in a typewriter company back in the 1980s. You would be bankrupt now. You would have lost all your money now because typewriter companies went bankrupt because nobody buys typewriters anymore. It happens. So, but if you were just invested in the broader market, an index fund of the entire market, you'd be sitting pretty right now. Sitting pretty. So another advantage of being highly diversified is that it's a no-brainer. It's like it takes no work. It takes no work. Actually, I'm going to stay this lane. And that's what you want to be. You don't want to have to be working at your investing career. I did that back in 2006, 7, 8, 9, 10. I was like almost full-time studying the market. And I look back at myself and I go, my God, I could have lost everything. I didn't know what the hell I was doing. I learned a lot, but it was so time-consuming. It was so and the irony is that if I would have just bought investment index funds, the way I'm teaching you now, broadly diversified, first of all, it takes the emotions out of it, so it makes life a lot more pleasant. Number two, it takes a lot of the time out of it, right? When you buy an index fund, it's a no-brainer. It requires no mental gymnastics, no work. You just buy the index funds, and you're going to do something called dollar cost averaging, which I'm going to get into in a second. And that's it. It's just no work. Every 3 months or every month or whenever you have extra money to invest that makes sense, you just go boom, you press a button, you invest. That's it. You're done. You're done. So what's dollar cost averaging? Dollar cost averaging is you're just buying into a particular investment or investments over time. And they call it dollar cost averaging because sometimes you'll buy, let's say you're buying the S&P index fund. We'll get into that a little later. So this is a particular investment. It's a broad index investment. It's meaning you're buying into hundreds and hundreds of companies at the same time. So that protects you because you're diversified. Anyway, so let's say in September you put in 5,000, and then and the price is at $10. I'm just using even numbers to make the concepts understandable. So September, October, November, December, you got another 5,000 to invest, and now the price is at $12. All right, so you buy at $12, not 10, but it's 12. Doesn't matter. So now the average price you paid for that stock was actually $11, right? 5,000 at 10, 5,000 at 12. 10, boom, boom, boom. It's $11. So your dollar cost average invested in, it came to $11. But you keep doing this. It could be 6 months later because, the economy goes into recession, blah, 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 and the S&P drops down to $8. So you buy at $8. So you're paying less than what you paid before, but that's okay. You're just doing the average. You have a 7-year minimum time horizon. So whether you buy at 8 now or 10 now or 12 now, it's almost irrelevant. There are some rare exceptions where you may not want to buy in, but we'll get into that at the moment. We'll get into that later on. So here we go. So we're at a bottleneck here in the Sherbrooke Street. So I'm in Sherbrooke Street in Montreal. So this is a bottleneck, meaning traffic jam, and it's just because of this one street here, Papineau Street, coming up. So if you go left, and you're going to find yourself on the bridge heading off the island of Montreal. If you don't know, Montreal is an island city in Canada. It's the French part of Canada. Anyway, so these middle class homes, lower middle class, I would say. Anyway, okay, so we covered a bunch of concepts, right? Dollar cost averaging. Yeah, so you just want to basically buy into those investments, those diversified investments over time, right? And the cost of the investments, the dollar cost, is averaged over time. You buy one time at $8, and then you buy the same investment at 10, then at 15, then back down to 9. But over time, but what's going to happen over time is the stock market goes up. That's the typical pattern of things. Now, it might not, but typically for the last 50, 60 years, it just goes up. But you just keep on investing, you keep on investing, you keep on investing. That's the way it's got to be done. Well, why is it upside down?